Hello and welcome to BloombergQuint. We are analyzing the GDP data. We were hoping to analyze just the Q3 GDP data, but we've got a host of revisions to go through. So this is going to be a little bit of a scratching our heads to see what the economy looks like. I'm going to read out the numbers. Stay with me for a minute so I can run you through the various revisions, and then we'll go across to our analysts. The number for Q3 is 4.7. Now that 4.7 is along expected lines because that was the consensus estimate, but that consensus estimate was based on the expectation that there is an improvement, marginal though, in the economy between Q2 and Q1. What you have now gotten is a revision for both Q1, Q2 numbers based on the FY19 revised data that came out a few weeks ago. So you have a scenario where GDP growth was at 5.6 in Q1, 5.1 in Q2 and 4.7 in Q3. So it tells you, if you go just by this data, that the economy continued to decelerate through these 3 quarters, despite the rate cuts, despite the attempts made by the government to actually shore up the economy. So if you go just by this data, it tells you that growth has not yet bottomed out. Now let's get into the trends on the sectoral divisions, but also the expenditure side trends. So let's pull up the expenditure side trends first, because that's got an interesting message for you. Private consumption, which a lot of people have been worried about, this is what the revised numbers for private consumption look like, Q1, Q2, Q3. 5% growth in Q1, 5.8% growth in Q2, 5.6% growth in Q3. Let's try and put those numbers up, even if from the website. What that is telling you in some ways is that private consumption growth remains below par because we were used to 7-8% kind of growth, but that there hasn't been any dramatic change in that, at least not since Q1. Investments is where the real story seems to be playing out, where the revised data shows a negative 5% in gross fixed capital formation in Q2 and a negative 4.1% in gross fixed capital formation in Q3. I don't know how far back we saw the last negative numbers. We'll lean on our economist panel for that. Government expenditure has been strong and has strengthened between Q2 and Q3, 11.7% growth in Q2, 11 and about 13% growth in Q3. Sectoral trends, very briefly, again, everything's gotten jumbled up with the revisions. So you've got a picture where agri has picked up, and that's at about 3.1% growth in Q2, real growth 3.5 in Q3. That's more or less along expected lines. Manufacturing, that revised data shows was reasonably okay in Q1 at 2.2% growth, and then has had 2 negative quarters of growth. Again, if we can get those graphics up, that will be useful. Then you have construction, which there has been a worry about. That has decelerated very quickly from 5.5% growth in the first quarter to 2.9 in the second, and then just 0.2 or 0.3, sorry, in Q3. Finance remains in the 6 to 7% kind of growth band. Now, let's see what we should make of all of this data. Soumya, Kanti, Ghosh of State Bank of India, best person to analyze data for us, and Siddhartha, Sanyal of Bandhan Bank, both joining us here. Soumya, let me come to you. Okay, lots of ups and downs, but what is the narrative on the economy if you go by the revised data is my first question to you.
Yes, I think, Kira, you have put it very nicely, the data, and let me now just dissect whatever I understand in this short time regarding the revisions. I think there has been a lot of revisions in the data, but the first thing you need to understand that in last year's data, the GDP number was actually revised downwards by around 93,000 crores. And this year's data, the number has been, what was revised in the estimates in January, the February GDP number for this current fiscal year is lower by around 95,000 crores. So basically, whatever the now advantage we had got in terms of an lower base last year, that has been almost negated by a correspondingly lower base this year, because there is also been a downward revision in the number which we had in January 2020 compared to February 2020. And interestingly, both the revisions are almost of the same proportion if I look into the FY19 revisions and the FY20 revisions. This is point number 1. Point number 2 is that I think the FY20 numbers now actually show a different, somehow different picture. It now shows that the slowdown which were witnessing in Q1, Q2, Q3 that maybe now be front loaded into the current fiscal year. So if I go by the purely again by the data, and even though the Q1 number of GDP is revised upwards from 5 to 5.6%, Q2 from 4.5 to 5.1%, and Q3 at 4.7%, in fact these revisions are actually purely basis of an downward adjustment of the current year data, because when I was comparing the earlier Q1 number with the today's Q1 number of this year, I found that this year's number was actually lower. So this means that whatever number it has been jacked up from say 5 to 5.6%, that is purely because of that statistical artifact which we have got. But the important message is that if we are moving down from 5.6 to 4.1 to 4.7, and possibly the Q4 number we extrapolated, the Q4 number looks at 4.7, but that will be downwardly revised because the corresponding GVA number for Q4 of this fiscal is at 5%, which is not possible because GVA cannot be higher than GDP in a scenario where fiscal situation it's so worrisome. So the moot point is that from 5.6 we have moved to 4.7 in Q3, and possibly we could move lower than 4.7. So the slowdown impact which we are talking about possibly now could be front loaded into the next fiscal.
Okay. Siddhartha, to you on some of the revisions within the individual sectors, I guess the big points to note is the revisions on the gross fixed capital formation side, which now tells you had 2 quarters of negative growth in investment. You've had 2 quarters of negative growth on manufacturing if you're looking at the sectoral side, and a very steep deceleration in growth on the construction side. But again, I don't know how you are juxtaposing the revisions with this time's data to build a narrative.
No, absolutely, and both you and Soumya put the narrative very nicely together. Now, what we get to see now that earlier we were trying to figure out when the last quarter's number initially was reported as 4.5%, and people were thinking from that as a reference point. The big consideration was that whether in the third quarter number we move higher than that. Eventually, if you just go by the current print, it looks higher, but actually, if I see the revised trajectory, actually we have continued to the momentum continues to move lower. Now, in terms of if I try to join the dots on the sectoral growth side, very importantly, the big shock that had come in case of the Q1 data was in terms of a dramatic drop in the consumption numbers, which is the mainstay of the economy more often than not, which is often close to 2/3 of the economy. There had been a very, very significant drop. And compared to that level, growth rate in that particular segment have improved slightly, but only slightly. So basically, given that this particular number is in the zone of 5.5 to 6%, this is possibly absorbing the scare to some extent, but at the same time not giving much of a comfort. And on the other hand, if I see that in this particular quarter, there had been a very significant push in terms of government spending, which grew in this particular environment at a 13% ballpark. That is possibly providing a lot of the support rather than support from investment and consumption. And that is getting reflected in terms of some of the other numbers in terms of manufacturing, construction. So as such, even though in terms of the broad headline, the number in this particular quarter had been in line with analysts' expectation and markets' expectation, and may not necessarily have a huge negative surprise when the markets open on Monday. But at the same time, we need to take this into account. The overall momentum in the economy still remains pretty subdued.
No, absolutely. I think expectations have no meaning in in a scenario where we've had so many revisions. Soumya, same question to you. To me, the standout revision on the expenditure side was the investment number. Does that gel with what we know both of say bank credit and other indicators?
Yes, before that, Ira, just one number which I'd like to highlight, which is also of interest. If you actually look into the core GVA, basically after stripping out the private part, the private GVA, basically that has expanded by 3.7%. So that has actually declined from 4.2% in Q2. So that means that the slowdown actually continues in the terms of a private investment. Now, the other important thing, Ira, I think the comparison, if you want to make a valid comparison in terms of the revised data, you should you must also know that if there was no revisions in the FY20 data, the FY20 GDP data today should have been at 5.7%. So the fact is that we are at 5% still at FY20 indicates that there was significant downward revision. And the most important data which actually stands out in terms of the downward revision in the advanced estimates today and the revised estimates in January is basically the manufacturing part, which now is supposed to grow at 0.9% opposed to 5.7%, and construction sector growth rate, which is half of what at 6.1% what was anticipated in FY19. So from that point of view, the story actually doesn't change much. Regarding your bank credit number, I will give you some interesting data today. I think the bank credit data which came out just as the GDP data was released actually shows some very remarkable revelations. In the month of January, the credit growth to the MSME sector has actually expanded by 38,700 crore, which is the highest since March 2019. So that's a positive thing. And the personal segment, which actually includes those other personal loans, basically export credit and housing, has expanded around 64,000 crore, which is a 27-month high. So retail credit continues to be strong, and it has been strong in January. The credit to MSME sector also has been strong in January. It remains to be seen whether it can be sustained or not. So credit data, if you look at a micro level, it's not that disappointing from the data which has been released today.
Okay, I hadn't looked at that data, to be completely honest, but I think the question I was asking was that that downtick that we have seen now for 2 quarters based on the revised data in the investment side. Let me come to you, Siddhartha, on that. That is in sync with what you were thinking. We're seeing negative 5% gross fixed capital formation in Q2, negative 4.1 in Q3.
So it's not too surprising that at this juncture, the gross fixed capital formation part is actually taking a bit of a hit, because at this, if you see in terms of business confidence and consumer confidence, the numbers are taking fresh dips. And typically, in the Indian context, 1 year forward expectations are typically very much rosier than what the near-term expectations are. That has always been the case for India. But even at this juncture, we are seeing that even forward-looking expectations are toning down. If you see the adjustment in just sheer adjustment in terms of near-term GDP expectation. In the month of July for this financial year, we were thinking growth rate will be somewhere close to 7%. By now, the debate is whether we'll be reaching 5% or we'll be sub 5%. So we have seen in a span of about 6-7 months, near-term GDP expectation getting revised down by 2 percentage points, and with continued uncertainty about future, global headwinds looking pretty dominant, and also all sorts of near-term factors are also not helping us, from significant natural calamities to the spread of the coronavirus at this moment. So none of the factors are really helping the investment climate, which needs augmentation of business confidence in a very significant extent. So as a result, if you get to see very poor investment or gross fixed capital formation numbers for the last 2 quarters, it's not very surprising, and one should not really be surprised if this number takes a bit of a time to really recover in a significant fashion. So it's better to remain keep your expectations contained around this particular factor. My sense is that the recovery prospects are at this juncture is linked or dependent, much more critically dependent on the recovery in the consumption part, whether from the current 5.5 to 6% zone, whether the consumption growth number starts moving higher, goes to 6 plus and closer to 7 kind of a zone, that will determine the course of GDP growth in the next few quarters, rather than depending on net exports or on investments.
Okay, a couple of more questions. Soumya, so before I get to what this means for policy, I have to ask, I mean, you have long experience in tracking Indian economic data. Is it usual to see such steep revisions in first FY19, then revisions in FY20? I mean, we are scratching our heads, it's fine. You can blame it on the journalist intelligence level, but what are policymakers going to make out of this?
No, I agree with your point, Ira. I think in the new series, the revisions has been a little more volatile, because I think the new series is still settling down, because there has been a lot of structural changes in the last 3 years in terms of demonetization. They happened, then GST happened, then RERA happened. So I think the numbers are still not settled. I will give an example. I think in one of the quarters, the GDP numbers were revised from 7.1 to 9.4%. So I haven't seen such a significant revision on a quarter-wise basis in any of the data. So I think the GDP numbers is still settling down. And but the important question, which I think you also asked me last time, I think the gross fixed capital formation this FY20 is actually growing at minus 0.6% advanced estimates, which is down from 10% projections. And the only positive thing which I can tell about the investment is that if you look at the change in stocks, that is at very low levels. So basically next year it could expand from the current level, because everybody has run down their stocks. And consumption at 5.3% projected growth rate, could be even lower, is the lowest since FY13. So I think the two mainstays of the growth story, consumption, investment, continues to be weak. And the final important thing is that any pandemic event, whenever it occurs, and there are empirical literature on this, that the impact of a pandemic impact on the growth is more severe than any possible generalized slowdown, which even that could be more than what happened in the global financial crisis. So that's something to watch out for. So there could be unanticipated surprises in the data. We hope it is not there, but there could be some unanticipated surprises in the data going forward, because the export numbers and the import numbers, if you all look into the revision, they doesn't at all look nice. So my sense is that it will take a while for the growth numbers to pick up from the current levels.
Okay, so what do we make of policy from here on, Siddhartha? I mean, technically, if the RBI were to look at this data in isolation, they are in a fix, right? Your GDP numbers are still slowing. Your core inflation has also started to go up along with headline inflation. So the MPC's role, I guess, would become tougher. And I'm deliberately saying MPC because I know the RBI seems to be sidestepping them.
No, absolutely. At this juncture, given the kind of, so technically they're inflation targeting central bank, and inflation is significantly higher than the zone where they wanted to, ideally wanted to be. So they are in a fix so far as the very near term policies are concerned. So our sense is that there is no room for them to move in the month of April. But given that the inflation trends in our view had been significantly, that clearly got a lot of upside surprise because of some of the near-term factors and near-term supply disruption, especially due to some short cycle crops. They, at some point of time, if they start to soften, they might actually surprise us favorably also at some point of time. It's true that at this juncture we are seeing some price pressure here and there in the economy, but if the significant turnaround takes place in case of prices of some of those crops, maybe the inflation number a few months, 3-4 months to 6 months down the line start looking a lot more benign. Now then they can actually, in terms of their action, also tie up also in terms of can be a lot more forthcoming in terms of providing support to growth. So our sense, and very clearly, as Soumya also mentioned just now, that my sense also is not that the growth numbers will really be recovering in a hurry. So overall, a few months down the line, we might actually be in a situation that growth numbers are still very, very subdued. The output gap is still very significant. And at the same time, inflation numbers are somewhat more benign than what it looks like at this moment. At that point of time, in terms of a rate action, our sense is that that particular window for RBI is absolutely not closed. It's very difficult for them to act at this juncture, but they have also very, very clearly underscored this particular point that they would like to stay accommodative for a very long period if needed. So very clearly they will stay accommodative. They will possibly wait for the appropriate opportunity to provide some more support in terms of rates. But what the RBI has done beautifully in the last policy is that they have effectively delivered a significant bit of easing even without cutting the rates. So that was possibly one particular area where a lot of focus will be there over the course of the next few policies, where in terms of rates the RBI's hands might be tied, whether the RBI can bring into some other regulatory easing which might lead to some further support to the economy in the near term when the RBI is not in a position to cut.
Okay, Soumya, last word to you. Would you be looking at some of the more reliable, the high frequency data which has not seen, so much volatility, the PMI numbers which have been to some extent reliable, some of the other numbers that you get from IIP, etc., and then making a judgment on whether more monetary easing is required, whether more government support is required in some form or the other?
Ira, before I say that, on a very lighter note, I would like to say, looking at the revised GDP numbers, it seems that there was perhaps the slowdown has now been front loaded. So what we are all discussing in the last couple of months was actually may not have been the best option. So maybe now we need to talk more about the slowdown, because the numbers are actually portraying that it is going to be front loaded. Now, having said that, I think the rate action, we believe that there is almost that could be 0 to 25 maximum, or we've seen there is very little possibility of a rate cut going forward, because what the RBI has been doing is it is taking unconventional steps in terms of LTRO, in terms of CRR adjustment, even though the impact of that may not be that significant in terms of an impact on the cost of funds of the banks or other things, but I think they are good signaling mechanism. And I believe that the RBI also going forward could continue with these options which they have done. LTRO, they have already done 1 lakh crore. They may do even more, because if you look into a deposit base of the Indian system for around 130 lakh crore, so 1 lakh crore number could be on the lower side. So this number incrementally could be higher, so that the impact on the cost of funds of the banks goes up. So my sense is that expect no sort of rate action, and as the budget has also unveiled, the budget was also a no surprise. So I will be very closely looking out for the surprises from the global economy, because there is already an impact of 30 basis points on the global GDP number of 84 trillion, and while the direct impact of India could be much lower, because India only has a share of 3.2% in the global GDP. I think the indirect impact in terms of the trade flow channel and also the financial markets channel could be very significant, because they are already witnessing some sort of reversal of capital flows in terms of portfolio capital flows in the last couple of days, and also the trade numbers, because remember that India imports a significant number from consumption items from China, which is where the share is more than 50%, and any disruption in that supply chain could actually lead to some sort of scarcity in the domestic market, and that could be an impact on prices. So overall, expect very gradual recovery, but as of now, I think the numbers are likely to be to be sub 5%, at least for the next couple of quarters.
All right, I'm going to leave it at that. Thank you both so much for trying to help us make sense of these GDP numbers. Do go on to BloombergQuint.com. We actually promise you all the data, the many revisions of the data, and then very soon analysis of the revised data as well. Thanks for watching.